And we're live, and welcome back to, I would argue, the session that I've been looking forward to the most in the Basecamp series, this Inventors special, where we have two wonderful guests who've both created tools of their own for the benefit of the technical analysis community and have taken the discipline of technical analysis forward in more ways than you can imagine. And this is something that I always encourage all technicians to think about: is not only devote yourself and your energy to the study of the subject, but also see how we can create something new. My name is Joel Pandikot, and I take care of the Asia Pacific operations for the CMT Association. And along with me are two wonderful gentlemen whom I want to welcome on stage very quickly. We have Julius de Kempenaer and Alex Cole, both inventors of their own tools, and both of whom will be speaking to us about their respective tools. So what we'll do is, Julius, we'll start with you, and I'll bring Alex off stage for a second. We can you can share your thoughts on the relative rotation graph, and then Alex, you and Tyler will join us to talk about go no go charts. And I'm very excited that as we look at Asia and the Asia Pacific region as a whole, there is so much volatility and there is so much going on that both your tools have so much to offer for market participants to take away. So on that note, over to you, Julius.
Thank you. That screen looks great. Let me make that a little bit better and bring it up here. So we're going to talk about relative rotation graphs. That's no surprise when you see my name, I guess. We've done this talk in 2019 during the conference in Mumbai, and we're going to, because this is Basecamp, this is the introduction to the big event in November. So we're gonna sort of relay that foundation and get you back up to speed for maybe everything you forgot about it. And if you've never seen it, you will have a good foundation of what relative rotation graphs are, how they are built, where they are coming from, and why they were designed, or how they came to life, basically. And to start my presentation, I want you to keep this number in mind, 1225, 1225, because down the line, you will find out, you will figure out, you will understand why that number is so important. So 1225 is the number that you need to keep in the back of your mind. Now, when we talk about investing, basically investing is all about choices. As an investor, you are facing a ton of choices every day, maybe even multiple times a day, I would say. Do you invest? Do you not invest? Where do you invest? Etc. etc. It's a lot of choices, and you have an overwhelming information overload, I think. So if you step into the shoes of an investor, I always try to simplify that process by drawing an investor's decision tree. And basically that tree starts with a big bag of dollars or rupees or euros in my case, or British pounds, or it doesn't really matter what your amount of money is, but you're having money and you need to go invest that. That's your first real choice. And then let's say that we have a simplified world where we need to choose between bonds and equities. It's a simple choice. Then we can continue there and we can expand the equity and the bond universe, say, in a layer of regions, maybe the US, Europe, and Asia. And you can also do that for equities, US, Europe, and Asia. And you can imagine that tree becomes more and more complicated, and it grows and it grows and it grows. And as we're in the business of decision making, and we need to constantly make a choice between two options, then in the technical analysis toolkit, there is really only one tool that will help you to make choices, and that is relative strength. And don't confuse that with the relative strength index. What I'm talking about is comparative relative strength, where we compare one security with another, where we compare a sector with a benchmark, where we compare a single stock with a sector benchmark, etc., etc. So we're going to compare various securities. And this chart shows you a basic relative strength chart. This is the Nifty IT index in India, and the chart below compares that sector, that IT sector, with the Nifty 500 index. And as you can see, that that relative strength line in the lower pane goes through various trends, and as you can see, they're quite different from what you see in the chart above. So they can go sideways, right here. They can go down, and when that blue line, when that relative strength line goes down, it means that this sector, so in this case IT sector, is underperforming the Nifty 500 index. When the relative strength line goes up, it means that the IT index is outperforming the Nifty 500 index, and when it goes sideways, it is in line, it's performing in line. So what we need to do, if your job is to beat the benchmark, or your desire is to beat the benchmark, is to try and find trends in that relative strength line. So not so much in the price itself, but much more in the relative strength line. And I think that this period here was the clearest. So let's say 2016 to half 2017, where the relative strength for the IT index went clearly lower, and the price itself didn't do much, moved kind of sideways. What this tells me is that the Nifty 500 over this period actually went up, and that's why the IT index was underperforming. If you take the period here where the relative strength line is clearly moving higher, this corresponds with the IT index moving higher, but it tells me that the IT index is moving up faster than the Nifty 500. And again, here it's sideways, and here you need to make a decision. And looking back, you could say that it is breaking below support. You can basically apply any technical analysis tool to that relative strength index. Now, the problem with this relative strength, with this basic relative strength, I call that raw relative strength, is that it is a one-on-one comparison. So you can only make a decision between those two ticker symbols here. And when you want to add more, in this case, sectors to a graph, this is how relative strength over history for a number of sectors is usually presented. It quickly becomes messy. And these are 12 sectors in the Indian stock market over the last 200 days. And you can see there is a huge difference between the top performers. They are like up 17, 18%. And the bottom performer here, which was the IT index, is down 26%. So basically, over that last 200 days, if you would have bought any of those, you would have picked up 17% positive. If you were invested in this sector here, you would have lost 26%. So obviously, it makes sense to try and find trends in those sectors. Now, my problem with this chart is that it is anchored to one point in the past. I don't think it looks very neat. To me, it looks messy. It's very hard to figure out which sector is where. The colors will help you a little bit, but not all that. But more importantly, it's very difficult to pick up trends in those relative strength lines, because, I mean, we're now anchored back 200 days, but I guess that if you eyeball, you can easily say that if you would have picked up that green line here, which I think is the finance sector, if I'm not mistaken, you would have picked that here, and you would have aligned that with, say, the purple one, which is the fast-moving consumer goods, that if you would have put your anchor right here, that finance index would have outperformed. So from this period onward, I much rather would like to have the finance index rather than the fast-moving consumer goods index. The problem with why that comes from is because it is anchored in the past to a fixed date, and that is something that makes it difficult to find trends, because trends are never fixed over the same period. Now, as I say, it becomes messy and it's hard to see trends. Now, if we go down to sectors in our decision tree, and this chart uses the American sectors because it took quite some time to put it together, and it's a ton of work to change all these ticker symbols, but you will understand what I mean later on. This has 10 sectors. So let's assume there is a 10 sector universe. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That means that in that universe, there are 100 possible combinations. 10 across the top, 10 towards the bottom, gives me 100 possible combinations. 100 comparisons that I would need to make to completely analyze that universe. Obviously, when I look at energy versus energy, that is useless because that is the same. So that comparison is 1. Same with technology versus technology. I don't need to do that. So that diagonal of 10 elements, which is exactly the number of elements in our universe, I can forget about that because they're comparing with themselves. That's not necessary. But when I've seen technology versus financials, I've also seen financials versus technology because they're the reverse. And the same goes for utilities versus energy. If I've seen that, I've also seen the comparison between energy and utilities, again, because they're the reverse. And that means that I can drop the bottom half of this graph. However, that still leaves me with 45 possible combinations, 45 charts that I need to check to get a proper understanding of what's happening in that sector. And there's actually a formula for that. I'm using the GICS classification, and GICS is a 4-layered classification system. It's got 10 sectors. We just saw those, which means 100. We can drop the number of elements in the universe, so minus 10 leaves us with 90. And as you saw, we can drop the bottom half, which divides it by 2. It leaves us with 45. 45 charts to figure out what's going on in a 10-sector universe. If we go down to industry groups, that's the second layer, then you will have 16 groups, which means 256 combinations. Minus 16 leaves me with 240. Divided by 2 is 120. That number of combinations balloons. Now, let's say we use the Nifty 50, so 50 stocks in India. How many charts would you need to watch in order to understand what's going on in the Nifty 50? 1,225, the number that I just gave you in the first slide. Got 50 stocks, times 50 is 2,500 combinations. We can drop 50 because that's the number of stocks in our universe. Leaves us with 2,450 divided by 2 is 1,225. Now imagine going over 1,225 charts to figure out what's going on in the Nifty 50, to figure out the big picture in that index. That's almost undoable. And even if you would take if you would go through the effort of flipping through 1,225 charts, you can only see one combination at a time. So, I mean, you would notice that maybe chart number 15 is looking very good, and 125 is looking very good, and 312 is looking very good. But it's very hard to actually put that in your head and to actually visualize that. And that's where Rrg comes in. Because what we're using there on those individual charts is what I call classic relative strength analysis. These 1225 are all one-on-one comparisons. 1225 charts that compare one stock against another, one stock against another, etc., etc. To get that broader context, to get that broader picture is much more difficult. And I'm going to go back to my military past. Maybe those of you who may have seen me before may know, but I spent 10 years in the Dutch Air Force. One of the things you learn in the military is that you always need what's called situational awareness. And military units, they try to get situational awareness by installing an overwatch unit. And overwatch units are what the term says, they are overwatching the battlefield. Ground troops, which you see here in the back, usually are small groups of observers and snipers who can oversee the battleground where the battle is taking place. They are in touch with the troops on the ground, and they will be able to direct them to where any enemies are or where your friendlies are. If you bring it more to an Air Force type analogy, you could think of an AWACS plane. These are the big Boeings with the radar dome on top. They fly at 40,000 feet, pretty much out of reach for any surface-to-air missile, and they can provide the helicopters, the jets, the whatever there is in that whole battlefield with information about that battlefield, because they are high up and they oversee that area. Basically, they're providing the big picture in one picture, and that is what Rrg also does. It provides you with the big picture of your investment landscape in one picture instead of having to flip through hundreds and hundreds of individual charts. And this is an Rrg. If you've never seen it, this is how an Rrg looks. And what we see here is the 50 stocks of the Nifty 50. So basically, this graph here captures 1225 relations. The center of the chart is the Nifty 500, and we're going to go into how this is constructed in a minute, but I wanted to give you the initial look and feel of what we're working with, and it will give you an idea of what is good, what is not so good, what is very bad, and what is getting better. And the good thing is that it not only tells you that versus its benchmark, which is the center of the chart, you can also compare, because of the calculations of the algorithms, you can also compare all these values among each other, which is very important because the raw relative strength numbers are usually not comparable. So what is a relative rotation graph? If we need to put a definition on it, then I would say that a relative rotation graph shows trends in relative strength, or relative performance if you wish, of multiple securities in a universe against a common benchmark and against each other. Now, be careful, they don't show relative performance as such, so they're not showing relative price performance. They're looking for trends in relative performance. It's a subtle difference, but it's an important difference. How do we do that? The basic building blocks for an Rrg are two indicators, the JDK-RS ratio and the JDK-RS momentum. And the chart here on top is the Fmcg index sector. It doesn't really matter. We could have used anything. Here is the relative strength, which I already showed you in a chart earlier with the IT index. And in the chart below, you see the red line, which is the JDK-RS ratio, and the green line is the JDK-RS momentum. Now, the RS ratio is our measure of trend. This indicator measures, it tries to pick up trends in relative strength and measure them. So the higher that value, the stronger that trend, the lower that value, the weaker that trend. If it's below 100, it's an uptrend. If it's if it's above 100, it's an uptrend. If it's below 100, it's a downtrend. That is when I started working with RRGs. Well, not even when I was at that time, RRG didn't even exist. I was working as an analyst on a trading floor, and I needed to talk to fund managers and traders about the European stock market, which was 600 stocks. There's 600 stocks in the stock 600, divided over 18 sectors at the time. And what I wanted to have is a ranking system, how I could rank those sectors from good to bad and those stocks from good to bad. And the reason for that was that the question that I got from all these investors is, what are your best 5 sectors? What are your best 5 stocks in technology? What are your best 5 stocks in chemicals? And when you do a 600 stock universe, obviously you don't know them all by heart and on top of your head. So obviously they would always ask me those questions for sectors that I didn't have prepared for that particular sales call. So I needed some sort of a system to rank that universe, and that became the RS ratio. Now, I'm not sure if you remember the dot-com bubble in 99 and 2000, where the Nasdaq went up to 5,000. Basically all these markets went berserk and went to great heights. Obviously, the relative strength for a lot of those stocks, for a lot of those sectors, went through the roof. And there is a trend following component in that algorithm. It compares sectors with a lot of other sectors, and as you need to find trends, you need a little bit of history to actually pick that up. And what happened in 2000, when the Nasdaq started to collapse, or basically the whole technology sector started to collapse, is that my RS ratio, my trending measure, continued to do very, very well and stay at very high levels. Sorry. And I got an email from an Italian hedge fund manager, basically saying, well, Julius, this time your system didn't work too well. And I was looking at it, and I had to think, he's right, so what am I going to do about that? And that became the RS momentum, because the RS ratio is a trend measure for relative strength. And as I told you before, with relative strength, you can use all the tools in your toolbox as a technical analyst. And rate of change, momentum, is a leading indicator. And I started to play around with rate of change. Now, obviously, with that rate of change, you had the same problems as with raw relative strength, that all these numerical values couldn't be compared across a universe, and I needed something that I could use across the whole universe. So I ran that rate of change idea through the same procedure as I did for the RS ratio, and that became the RS momentum. And it's sort of an early warning system. And if you look in this chart, you can see that when the green line, that's the RS momentum line, when it crosses above 100, the red line, the RS ratio, has put in a low and started to move back up. And also the reverse, when the RS momentum line drops below 100, the RS ratio has created a peak and has started to move down. So now I had 2 values which I could compare across the universe, which could help me to create some sort of a ranking across all these sectors. And when I started to do that, I had that for quite a long time. I only had those 2 values in a table. I never graphed them. And someday I started to play around with that table, and literally in Excel, very simple, just that table with those values which I had calculated. and start playing around. And at some stage, I hit, in Excel, when you have that, you can choose graphs and just flip through various graph formats. And at some stage, I hit that scatter plot, that basic scatter plot, and saw little dots on a screen. And I needed to look first at what I was actually looking at, because when you have never seen it before, something like, oh, what is it? What I'm actually seeing here? Because it looked quite nice, but I had no idea what I was looking at. So to talk you through that, this is the basic construction of an RRG. On the horizontal scale is the JDK-RS ratio, which is that red line on the graph. On the vertical scale is the JDK-RS momentum, which is that green line on the graph. So in the top right-hand corner, you find sectors. Let's stick with sectors. It can actually be anything. It can be stocks, can be bonds, can be currencies, can be cryptocurrencies, can be asset classes, can be anything. So in the top right-hand quadrant, you find securities that are in a relative uptrend, and that uptrend is being pushed up by a strong momentum. Well, the first thing that will happen, because rate of change is a leading indicator, is that they will drop into the weakening quadrant, and that's when that momentum drops below 100. That means that the relative uptrend is still there, but it's losing momentum. It's starting to lose strength. And then when that loss of strength continues, eventually they will rotate into the lagging quadrant. And there you will find securities that are in a relative downtrend, and they are being pushed further down by weak momentum. And then obviously, just as on the weakening, the first thing that will happen is that momentum will start to pick up, and it will move the security into the improving quadrant, which is where they still are in a relative downtrend, but they are being pushed up by strong momentum. And if you play that over time, you will actually see that rotation taking place. That's where the term relative rotation graph comes from. And quite frankly, until then, there's a lot of people always talking about sector rotation. But until I had this on my screen, it was only, price time-based charts that showed that sine wave, and people say, hey, there is sector rotation going on. This chart, which later became an RRG, actually showed that these sectors are rotating around a benchmark, which is the center of your chart. And they do that in a clockwise sequence. And I think that was my big sort of aha moment, maybe, if you want. And this was the first visual, like just one dot for every sector on that plot. And you can already immediately see what is good and what is not so good. And I had this on for a while already. And then I thought, you know what, I need to see where it's actually coming from, because the fact that automobiles are in leading, that's nice, but was it coming from here? Was it coming from there? Where is it coming from? So in my still at that time Excel spreadsheet with a gazillion lines of Visual Basic code, which only I could read, which is always the problem when you have big spreadsheets. You can never give it to someone else because they won't understand it. I added the previous observation, and that allowed me already to get a little bit more insight into what these sectors are doing. And you can add a little bit more. And it was at that time when I was still working as an analyst, and Fidelity was one of my clients, Fidelity in Boston. And you may know the name of Dave Keller, who's past president of the CMTA. He was managing director of research of the technical analysis team in Boston, and he was one of my contacts. So he got my research, and he got my documents and my publications. I was speaking to him on the phone one day, and he said, you know what, I always print the last page of your publication and stick it on the wall. And the last page of my publication basically held this chart here. And so I asked him, why do you do that? And he said, you know what, after a while, I have a stack of paper, and I can actually flip through that stack. And you remember, if you were in high school and you had a notebook, and when you were bored, you started drawing these little puppets on the bottom of your notepad, and you can actually make them walk or crawl up a ladder or something. That's what he did with Rrg. And not only enabled it him to see a little bit longer term history, actually, and this is a 30-week, we call these tails, so this is a 30-week tail, and you can see that it becomes quite messy. And then I had to think about the story that Dave told me, because if we were able to make that happen, then we only needed, in this case, it's a 3-week tail, but if you animate it, you can actually see that rotation playing out over time. So you can see that rotation taking shape, and it gives you a very good insight of what's going on and what the rotational pattern is in that particular sector. And here we're talking about the Indian sectors, but as you can imagine, you you can do that for anything. You can do it for US markets, global markets, every bond markets. We do it for currencies, we do it for cryptocurrencies, anything, as long as you put apples and oranges into the same, so apples and apples into the system, not apples and oranges. And the most important thing is when you start to work with bonds, if you want to compare stocks and bonds, you need a total return bond index. You don't want to use a yield, because that obviously is the reverse, and that messes up the whole system. Now, next thing, of course, when this was developed, is what are the rules of thumb? How do I interpret this? How can I actually make sense of it? And my initial, let me talk you through this. So in the top right-hand corner, that's probably what you should hold, because they're in a relative uptrend and the trend's being pushed higher. That's good. You want to have that in your portfolio. When it drops into the weakening quadrant, you are either looking for sells or for rebuys. And the rebuys is, you may have noticed that when I played the rotation on the previous chart, when there is a very strong uptrend or a very strong downtrend, there is a possibility that the tail, that the rotation completes completely on the right-hand side of the graph. So when you move from improving to leading, that's when you switch from a downtrend to an uptrend. If you then go from leading into weakening and back up into leading without hitting lagging, what actually happens is that sector or that stock is entering a new uplag in an already existing uptrend, which obviously is a lot more reliable than a switch from a downtrend to an uptrend. That's why rebuys, so something that is inside weakening but curling back up and going straight back up into leading, is usually a very strong signal. When something's in the lagging quadrant, you better avoid it, because it's in a relative downtrend, and that downtrend is being pushed further down by weak momentum. And then when you are in the improving quadrant, that's where you're looking for buys or resells, because we can have the same situation as I described for rebuys here on the left-hand side, where a very weak stock moves into the improving quadrant, rolls over, goes back into the lagging quadrant, basically igniting, starting a new down leg in an already declining relative trend. Now, when I first started all this, my initial thought was, when something moves from improving to, I thought I'd done it. I thought I had the holy grail. You know what? When it's moving from improving to leading, that's when you buy. When it moves from weakening into lagging, that's when you sell. Truth is that you're very conservative. In reality, before something moves, there's already quite a bit of a relative move and a price move underway before you actually move over the quadrants, because you need in some form, you need to pick up a trend. So then I thought, if that's so, if that takes so long time, then why not do it the other way? So we're going to buy when you move from lagging to improving, and you're going to sell when you go from leading to weakening. Truth is, that is very aggressive. And over the years, I think that the best way to explain it is that, because this is a chart format. It's a chart format. It's not a trading system. It's a way of visualizing a market. And if you look at a simple bar chart, and a lot of people use moving averages, and I think that crossing the on the horizontal axis, so the JDK RS momentum, if you're very aggressive, which probably is compared to like a 5-day moving average. If you wait longer and use the crossings from improving to leading and vice versa, that's maybe a 50 or 100-day moving average. So it depends very much on what type of trader you are, what your investment horizon is, how aggressive or how conservative you want to be. But the Rrg chart will help you either way, as long as you understand that if you use this type of moves, you're very aggressive. If you are using the horizontal type move, you are very conservative. The truth might be somewhere in the middle. Different for everybody. Now, since the initial development of RRGs, we've developed a number of what we call derived indicators. And I will quickly browse you through all of them. They're quadrant bars, Rrg Trend Bars, Rrg Angle Rate of Change, Rrg Distance, Rrg Velocity, and Rrg Heading. And the reason these were developed was because we got a lot of questions about what is your performance, what are the rules, what are your trading rules, etc. And as I just explained, there are no real rules. It depends very much on what type of trader you are. Are you very aggressive? Are you more conservative? What is your goal with this? And to help you with that, the derived indicators may shine a little bit more light on it. Now, the quadrant bars, they're easy to understand. They will color the bars in a bar chart based on the color of the quadrant on the Rrg. So here we've got the Fmcg sector, and you can immediately see here it's in the leading quadrant, here it's in the weakening quadrant, briefly into leading, weakening, and then it drops into lagging, goes into improving, and picks up leading again. But this basically follows exactly what's happening here with these Rrg lines. The Rrg Trend Bars, they have another algorithm behind it, because, as I explained, you can have situations where a trend rotates completely on the right-hand side. So from leading into weakening and back into leading. And we see a situation like that right here. So both lines above 100 means that the bars become green because we're in the leading quadrant. And then you see that the RS momentum line drops below 100. That's when the bars here turn orange. We're in the weakening quadrant. And then it picks up again and briefly comes back above 100. That's what's happening right here. If you look at the actual trend in the relative strength line, that's still pretty good. And the Rrg Trend Bars try to detect when a rotation is it's a very strong trend and the rotation is only temporary and it goes back to leading, or the rotation is actually going from leading into lagging. That's where they become trend bars. Now it's the exact same chart, but you can see that the bars that were orange in my previous chart are here still green. So that algorithm picks up the fact that this trend is still going on and only rolls over right here when it's briefly going to weakening, and then rapidly when the red line crosses below 100 becomes in the lagging quadrant. That's right here. And then we go to the sequence where we go improving and back to leading. So the trend bars, they help you identify really strong and really weak trends. The other indicators are based on navigation with a compass. You all know what a compass looks like. You know, you got that nice thing, and 360 or 0 at the top is due north. 90 degrees is due east, south is 100, and west is 270. And if you put this in your head, you can understand how angle rate of change, and heading work. Because the angle, we put the compass centered on the center of the graph, and we draw a line from the center of the graph to the last observation on the tail. So here we have an Rrg angle of a little bit over 30 degrees. Now, if we take the previous observation, so that's the previous node on that tail, and draw a line through the center of the chart there, you can see that the angle there was about 15. So the angle rate of change is the difference between those observations. These two indicators, they help us to pretty much exactly tell you where a security is and where it came from in a very numerical value. So you can use this in more quant-based approaches for Rrg. The distance measures the distance on the RS ratio scale, the distance on the RS momentum scale, and then we can calculate the distance of the point of the last node towards the center of the chart by basically using Pythagoras' theorem, which you've all learned in high school. And if you haven't, look it up, because it's very important when you want to use when you want to calculate distances on a scatter plot or anything else. The third one is velocity, and velocity measures the differences, the distances between the various nodes on the tail. So by adding them up, I can actually calculate the tail length, and tail length tells me something about how strong that move is. And if these distances are increasing, then it tells me that the move is getting stronger and stronger. And then we have heading, which is probably the most important one, which positions the compass at the previous observation and then tells me that the previous observation, and I can then tell that the heading here is around 60 degrees. Now, I need to hurry up, I see. Got a couple of minutes left. As I said, a lot of people asking what are your backtest results, what are the trading rules. That's very difficult because there's a ton of different investors, there's different universes, there's different restrictions. So there's not one single rule set. But with these derived indicators and the work that we've done, we can actually signal test and trade test and generate what-if scenarios and get a general sense or a general expectation of how these tails move based on the numbers of the derived indicators. And what it helps, what we've seen is that Rrg heading is definitely adding value to that. And with combining these numbers, you can actually create a custom ranking system using various variables in the Rrg ecosystem. And I've done a couple of tests, just ran a couple of quick tests. And the period that I used is from 2005 to 2011, because that is a flat period. There is pretty much nothing going on. So I wanted to see if my rule set would hold up in both up and down moves. We're using weekly data and we're calculating relative returns. Now, if you do that for the sectors, for the NSE sectors, for the Nifty sectors, over that 5-year period, you had 307 results, and this is the actual outcome. So 13 weeks after that turn is signaled. So what we're looking for is a turn into that 0 to 90 degree angle, Rrg heading into 0 to 90 degrees. So that looks pretty good. If we do the same test out of sample, which starts in January 2012 and runs until the end of 2021, we can see that that result scheme actually holds up very well and continues to perform. We've also done that for all 50 stocks in the Nifty 50 index. This is again in sample 2005 to 2011. And you can see that the results are actually pretty good. Mean return 6%, 6% probable gain. The results are nicely skewed to the right, because that's what you want. You want more positive results than negative results. And if we do that out of sample, you can see that this actually holds up. These are a couple of things what you can do with those derived indicators, if you wish. And what I then did is a year ago, we started working with a big CFD provider in the UK. And we are running a number of what they call share baskets. And the Rrg share baskets are based on a rule-based strategy around Rrg. And the rules, and I'm going to wrap it up, the rules are the tail needs to be at a Rrg heading between 0 and 90 degrees. That's strong relative strength. The closing price of a stock needs to be above its 10-week moving average. We want to buy stocks that are going up. We do that for the entire universe. And I've done that here for the Nifty 500, so all 500 stocks in the Nifty 500. If there are more that, and we're going to create a portfolio of 10 stocks, 10% each. So you can see that that's right here. 10 positions, 10% each, and we are rebalancing on a quarterly basis using weekly data. And if you do that, this is your result. And it's quite staggering, I have to say. This is I haven't done it for the Indian market. We've done it for the S&P 500, for the NASDAQ, for US growth, for DAX, for Hong Kong. And they're all coming out pretty good, but this is actually very good. And you can see where the strength comes in, and this is where the MA kicks you out. Here, there are no stocks trading above their 10-week moving average, and that keeps you down, limiting your drawdown in these periods. And the 2018-2020 period is the biggest drawdown, about 34%. Market itself went down much further, and this is your recovery period. So all in all, and I warn you, it'll be very hard to copy this in the real world. We are seeing that now. We're doing that more than a year now with those baskets with that CFD provider, but the results are still pretty good. The reason I'm showing you this is to show you that combining Rrg with another basic technical tool as a moving average can help you get a better trading system or a better view of what's going on in the markets. I'm afraid I need to cut it short here. I had one thing for ranking that was in the old presentation as well. If you've got any questions, please reach out. I'm very happy to discuss anything you want to ask. And otherwise, if you need access to Rrgs, either go to optima.com/Rrg or stockcharts.com/India for the Indian market. Again, Joel, if you want to take it back and see how we can do this.
Yeah, thank you so much, Julius. Such a pleasure as always. And for me, I think today's session was extra special because in 2019, when you presented this, I was not able to be in the room at all, except to make sure that your session actually started off properly. So for me, this has been such a wonderful refresher to the tool that I've come to appreciate a lot since 2010 when I got introduced to it on the Bloomberg terminal. Was it 2010 or a little after that, wasn't it?
It was launched on Bloomberg in 2011, January 2011. Yeah,
that is correct. That's correct. And I remember because I remember actually talking about this tool and how fascinating I found it to a number of folks who were at that time looking to subscribe to Bloomberg's. And I must say, there is so much to take away from this conversation. And there are some very clear applications, like you illustrated, in comparing index constituents to the index and various indices with each other. How do these translate across asset classes? That's something I'm very keen to understand. Is so barring outside the world of equities, what nuances must one take care of when looking at this world?
Well, I mean, I think I've already mentioned one, which is if you compare stocks and I mean, if you start the investment pyramid, as I explained, you got a big bag of dollars and you want to decide between bonds and stocks. That's obviously a very simple decision. But you can imagine that your asset allocation layer is a bit bigger. So you may have stocks, you may have government bonds, you may have high yield bonds, corporate bonds, maybe cash, gold, cryptocurrency. I don't know. I mean, you got a layer. Then what I do is I put those ticker symbols on an RRG, and you need to find a suitable benchmark. That's important.
Got it. Yeah.
And I do that in my show on stock charts. I look at asset classes every week, and I use a Vanguard ETF, which is VBINX, which is the Vanguard Balanced Index Fund. It's
Right.
very US centric, but it consists of 60% US stocks and 40% US bonds. So that represents that's a benchmark that is used by a lot of RIAs, registered investment advisors, for their to compare their client portfolios, because basically that is your standard portfolio. And if you use that as the benchmark and you plot those asset classes around it, it will help you to say, hey, we need to overweight stocks and underweight
Got it.
bonds,
Got it.
or maybe we need to go to cash because cash is doing really well, or maybe cryptocurrencies are coming in. So you can actually play around with the weightings of your asset classes in your portfolio, which, by the way, I think is a lot of people don't do that. A lot of people just dive straight into the stock market, and that's the only thing they do. Start trading stocks, start trading options, basically having 100% of their portfolio allocated to stock market, which is super high risk. So starting at a higher level, saying, hey, it might help you. And nowadays there are so many ETFs that help you to get exposure to bonds. So if you don't
True.
want to do a deep dive into the bond market and buy and sell individual bonds or high yield bonds, because that's a very specialized market. You can just buy an ETF, but then at
Right.
the higher level of your portfolio, you will have the exposure to that market through that ETF and concentrate, if you like it, on finding individual stocks or sectors, etc.
That is so true. That makes a lot of sense as well, Julius. Thank you so much. I mean, I could keep asking you questions left, right, and center. I'm wondering a lot about the world of cryptocurrencies as well, because that's really, it has been the
Yeah, I
flavor
know. I
of
mean, I tell
this.
you, I had a few charts prepared for Asian markets and the sectors, etc., etc. We ran out of time. That's totally to blame on me. I spent too much time on explaining it, but
No,
I don't
but it's
know.
it's a very valuable session, Julius. And if you are up for it, I'd love to have a follow up, a more advanced session where we dive into different markets and actually, experience their
Yeah, and we can
nuances.
look at what's actually happening in the markets. I'd be happy to do that for you guys.
That'll be fun. In fact, I'd love to make this session compulsory viewing for anyone to come and join that session as well, so we can have a more advanced conversation.
It
And
will
speaking of
save us
compulsory,
about 40 minutes of talking about the explanation and the background, and dive straight into what's happening in the markets.
that is so true. I think that's super useful, because the reason I bring this up is we are currently running an investment challenge where we have about 1,000 participants from both CMT candidates as well as students from our academic partner schools who are currently going through an investment management competition where they are expected to manage money based on real world rules, right? Everything from long only, a minimum holding period of 2 days, 2 months of virtual money management, and uh, a tool like RRG gives you so much context into diving deeper into what the markets can hold and how to make sense of indices and their constituents that you might not have interacted with earlier. So, yeah, I think this is turning into markets and RRG 101, and I'd love to plan for something for the future as well.
I will be on the lookout for your email.
Looking forward to it myself as well, Julius. Thank you so much once again.
You're welcome.
And once again, Julius, such a pleasure as always. Thank you so much. Let me just quickly pull up my screen and share a few comments that I'm really excited about with what is going on with the CMT Association, and more specifically, what's happening in Asia. And There is so much to say. I mentioned while chatting with Julius that we're having some fun events such as the investment challenge that's going on right now. And in Asia, we're seeing some tremendous uptake for that. We are seeing interest both from the employer fraternity, where we are seeing greater use of technical analysis done right, the way the CMT Association talks about a more rigorous and meaningful way of doing technical analysis. And at the same time, we are seeing within the academic space as well, business schools and universities are now trying to integrate more and more technical analysis within the curriculum so that as students graduate into the industry and become industry participants, they have a meaningful mix of both an understanding of intrinsic valuation as well as technical analysis and market behavior as viewed from that lens. So with that growth in Asia, we saw a lot happening in terms of an increase in the number of test takers of the CMT program. We've seen over the past few years, not only did we see a lot of growth coming out of India, on the basis of which we set up an office right here, and I'm proud to be the first employee of the CMT Association outside New York, which theoretically makes me the first wave of the global expansion, if you mind. But having said that, in addition, what we also have is the number of test takers across Asia overtook the number of test takers from any other continent in 2019. In 2020, India became the single largest test taking country. And so in 2021, the board of directors of the CMT Association put together a team, a subcommittee of the board, to really help drive the growth for CMT Association across Asia and the Pacific. And when we talk about Asia, we include West Asia or the Middle East as well. And so these upstanding members of the CMT community have been driving this growth. Akshay and Vishal are based in India. Akira-san is based in Japan. Jamie, who's also a member of the board, has recently moved to Sydney. Ananda Bhaumik lives and works in Hong Kong. Jake Chow in Singapore, and Jigar Mehta in the Middle East. And the reason I bring this up is for members of the CMT Association and for those who are looking to learn more about the region. These fine gentlemen are all available and accessible on our Discord platform as well. So I definitely encourage everyone to join. And in the lead up to this growth in the community, something I'm really excited about is coming up on the 5th of November, the Asia Pacific Summit. And I'm very happy to announce that we have very strong sponsored organizations as well, starting with Sher Khan, our platinum sponsor. And these organizations are really helping us to take the mission of the CMT Association forward in not just the Indian but the Asian financial markets as well. And so, with that in mind, I really invite everyone to participate in what we're calling the Asia Pacific Summit Experience. And that summit experience is a mix of both virtual as well as in person events. The Basecamp session that you're attending right now, irrespective of whether you are on Discord or YouTube Live or on LinkedIn, this is part of the virtual side of the experience in the lead up to the summit, which is why we call it the Basecamp. On the day of the summit itself, you will be able to virtually access a simulcast of the event on the app for those who register for the summit. But if you are there in person, that is another experience altogether, because there is while the virtual world has become common currency now, there is no substitute to just shaking someone warmly by the hand, building those real relationships which form the bedrock of the CMT Association and the success that we've seen for the past 50 years. So why participate? These four core pillars of the CMT experience: knowledge, network, growing your career, finding new career opportunities, and building your personal brand as well. The Summit Basecamp is yet another opportunity that we've created for this. Like I mentioned on Discord, we're seeing a lot of excitement in terms of not just for the summit and the Basecamp, and we're seeing folks join. We already have more than 3,500 members there, all interested in and fascinated by the markets and talking about it from a very mature, responsible lens. So, in order to participate in the Summit Basecamp and in our Discord experience in general, I would invite everyone to come to our Discord handle, sorry, our Discord server. The simplest way to do it online is to go to cmta.fyi/discord. Or if you are on Discord, our server is searchable. You can just search for CMT Association and you'll find the server. Once you get to the server, you'll see where I have the little white waves, a register channel. You get into the register channel and fill in the form that you see there, the Discord form. And when you do, you will be able to access a whole number of channels that are dedicated to different, very interesting initiatives that we are running based on different themes and topics. Like I'd mentioned, the investment challenge is also running on Discord. and it's made for such warm, rich conversations that I think everyone ought to participate and learn from them. On Discord itself, in addition to various channels built around various topics and initiatives, on the right hand side, you'll also see members who are currently active on Discord. And this is an opportunity for you to get to know folks from the space and get to engage with them in a way that is a secure, because security is matters to us deeply, and b yet generous and thoughtful. So with that in mind, I would also encourage you to look at all the various events that we put up on the events calendar from time to time. Do join in, attend the various sessions. There are conversations going on right now, and like this, in the lead up to the summit, we also want to pick some very nice, meaningful, rich conversations and bring them to the surface as well. We also conduct a lot of stage style sessions where we can have conversations about various themes, and we're very happy to bring in your thoughts and suggestions of not just what topics you'd like to discuss, but what speakers you'd like discussing them. And that's something we're very excited about as well. So with that in mind, what are you waiting for? Act now, register for the CMT Summit, the Asia Pacific Summit. And in fact, the end of this year, early next year, the CMT Association turns 50 years old. So in addition to the Asia Pacific Summit, we also have a really rich blowout of an event that is going to be our global symposium. I encourage you to keep your eye out for everything that's going on within the CMT Association, because there's a lot to take away, both in terms of learning and relationships. So with that in mind, act now, join us, meet us on Discord, register for the summit. There's a lot to be done there, and I'll see you in Mumbai. So, on that very pleasant note, let me bring my dear friend Tyler Wood, Ram, and Alex Cole as soon as he was able to join on screen. Good to see you again, Tyler. Good to
It's
see you.
it,
A while.
it's great to see you. Can you hear me okay?
Loud and clear. It's all good.
Fantastic. Yeah, for everybody who's online on LinkedIn or on Discord, really appreciate you spending the afternoon and the evening with us. That session that we just saw from Julius was fantastic, and seeing it in person at the Mumbai Summit in 2019 was really an honor. Both Alex and I have known Julius for well over 10 years. Joel, you talked about getting to meet him in 2011 in your role at Bloomberg, and just
That,
yeah,
that,
go ahead, Alex.
that might have been the first time I've seen such an up close and personal intro to RRG since about 2011 at Bloomberg, when it was introduced to us. So just fantastic, and for me, it feels like almost like being a professional tennis player meeting Roger Federer. He's one of the first inventors in the space. In a long time, creating a product that people use around the world, and it was just fantastic to see the presentation again.
Let me just quickly embarrass Julius by bringing him up on stage while you are bathing him with compliments. Meanwhile, Tyler, whenever you're ready, you can share your screen as well.
Have you ever seen a Dutchman blush quite like that?
I mean, you just managed to shut me up.
No, Julius, that was.
Thank you, guys. Thank you. I really appreciate it coming from you. And I just. I mean, it's an honor to work with the CMTA, and Tyler and Alex. I know you guys for a long time. Tyler with the CMTA, Joel at Bloomberg, Alex at Bloomberg. I mean, Bloomberg was instrumental for RRG. I've got to say that. I mean, it was the first. Actually, Eugene Sorensen at the time was the man who actually basically had the guts to put it on, because it was brand new. I mean, he never knew how it would pan out, but. Looking back 11 years now, actually, I think we're doing okay. So thank you for that.
Doing really well, and I feel like it kind of drives to the heart of what the CMT Association does, which is foster some community, foster some dialogue, some collegial discourse. As we were just chatting off screen, the idea of first principles of the market, the relative strength having power to propel not only your new data visualization tools, but also how investors think about asset allocation. And that comes back to the very early members of the organization who were busy at work, inventing and creating new studies and new indicators. And as Alex said, it had been a while since anybody came along with something really dynamic and really provocative in our space. So kudos to you, Julius.
Thank you, guys. Good luck with your presentation. I love the go no go visuals with this shading. That's really nice.
Awesome. Well, we'll see you at least back in New York, April 26th through the 28th.
For
Maybe
sure.
not before then. All right. Cheers.
On that
Julius.
note, I'll pull Julius and myself off, and Tyler, the stage is yours.
Fantastic. Thank you, Joel. So just by way of introduction, I'm Tyler Wood, recent CMT charter holder. I'm the managing director at the CMT Association. But a few years ago, I also became the co-founder of Go No Go Charts with my dear friend, Alex Cole. And so what we're going to do today is basically pick up where we left off. We've done the 101 session explaining the idea of blending technical indicators. I'll give you just a couple of minutes of review, and then we're going to dive into this concept of relative strength, building off of exactly what Julius was sharing with us this morning. And the idea that institutional investors are focused on beating a benchmark. Many are in the absolute return space, but the majority of our clients who are in mutual funds, long only, or equity managers, they're really focused on relative performance. So we're going to talk a lot about that concept today. But if you can all hear me and see these charts, let's dive right in. And just a quick review in case you weren't on our session earlier this week. We're starting with this quote from John Henry because he's an incredible trend-following investment manager, learned the trade in the commodity space, came from very humble beginnings on a farm in Southern Illinois, but he's gone on to own the Red Sox baseball club, Liverpool football, Roush Fenway Racing, all on this idea that if you can remove your own emotional bias, if you can become objective and quantify what you're seeing from a statistical perspective, you have this huge advantage. So it works in trading as well as in sports. You might be familiar with the name John Henry if you've read the book or seen the movie Moneyball. And of course, you've seen the Boston Red Sox go on to be a championship winning team for many years because they changed the way that they did player selection. It wasn't just about somebody's belief or the narrative around, this guy comes from a great family of pitchers and we know he's got a strong arm. No. We got to look at the stats. We got to look at how they actually perform and assemble a team that fits together and plays well. We also went through, and my dear friend Alex, if you haven't caught the earlier session, please go back and check that out. Really just walking through what a responsible approach to trend following might look like. So having a checklist, being objective. How do you define the start and the end of a trend using multiple indicators to give you a sense of the weight of the evidence and be able to have some confirmation that indeed that trend is beginning or indeed that trend is ending. The last slide that we went through on Tuesday's session was just talking about how that objective rules-based process is going to take your emotions out of the equation. So go ahead, raise your hand. We can't see you. It's a virtual seminar. Raise your hand at home if you've ever had a trade that became an investment. You just had such high conviction in this individual security or the ETF that you bought. You knew it was going to come back in your favor, so you held on. Down 10%, 15, 20, 30%, maybe half. Maybe you lost a ton on this because you just had this high conviction that it was coming back in your direction. So what we're looking at on screen is the expectancy formula. It just quickly shows that all of the trading strategies along this efficient frontier, along this curve, are going to break even. And it's the combination between the percentage of winning trades and the profitability of those that work out. So right here, we've got a coin flip, 50-50. This might be very good news, right? If you don't have any edge in the market in picking securities, if you just pick at random, but you have really solid risk management so that you can let winners run and cut losers short. Remember, that's really simple to say and very difficult to execute. That's what we're going to talk about today. We're not just going to lean on security selection, although Go No Go charts are going to help with that as well. We want to talk to you about your trading discipline and about being very objective in your buy and sell decisions. So that responsible checklist that we went through, a few different technical indicators blended together. Well, what that leads to is the problem with technical analysis. And Alex and I have been doing this for a very long time. My role at the CMT has been an incredible perch on which to work with institutional money managers, research analysts, and traders. Alex as well at Bloomberg. What we have come to find is that even those with the most robust and responsible process can have a very difficult time translating their research and their analytics into buy and sell trade decisions, because you introduce more emotional bias the more complex your chart becomes. So we want to simplify our chart, keep our focus on price, because price is what pays, and we want to avoid that analysis paralysis. So from better charts come better decisions. Alex, talk to us just for a second about the go, no go trend chart and what these colors mean.
Yep. So you'd have seen this on the last session, but what we've been really trying hard to do is create a chart that gives you a complete sense of the technical analysis picture, in this case, the trend, but without putting anything else on the chart to overwhelm your decision making or to clutter that chart. So what we end up with is blending some of the foundational concepts and some of the most robust tested tools in trend following into one indicator that color codes the price bars based on the strength of that trend. So what you're looking at here quickly is when the stocks are in a go trend, we'll see blue and aqua colors. When the stock or the asset that you're looking at is in a no-go trend, you'll see pinks and purples. And when you see amber bars, that's often a transition between trend or sometimes just areas of uncertainty. And we call those the go fish bars, because Jesse Livermore once said there's a time to go long, a time to go short, and a time to just go fishing, meaning if the market's not giving you anything, then just, let it be, take a break and do nothing. And so those are the strong and weak form of a go trend, blue and aqua, strong and weak form of a no-go, pink and purple, and then the amber uncertain bars called our go fish bars.
Absolutely. Now, what's fascinating is that even in that simple technical checklist, when we're looking at 6 or 7 indicators to confirm what we're seeing in trend, that can quickly clutter a chart. What's happening behind the scenes on a go-no-go trend is actually much more data, much more complex, because we want to have a complete technical picture. We want to use everything at our disposal to have the most objective view of a trend actually beginning and the direction and the veracity of that move. Now, the simplicity of looking at a price chart, it's great if you're an equity investor and you can put this to work on equities, but we also want to look across the asset classes, as John Murphy and Marcos Katsanos and others have shown us, and really what Julius mentioned today. The diversification across asset classes is key to long-term investment success. So if we're just looking at the trend and we can look across the asset classes, we can get a clear picture of what the nature of the market is, or what the behavior of price moves have been. We went through this just the other day. Equities in a strong no-go, treasury bond prices strong no-go, oil in a strong no-go, although that has come back in a favorable direction a bit since we pulled these charts. Bitcoin still in a weak no-go. Gold, surprising in a inflationary economy, no flight to safety here. Strong no-go trend on gold. That's been nobody's friend. And here's our lone standout, the US dollar, really outperforming the world's currencies and all other asset classes. Now, it's great to have a multi-chart layout like this, but what data visualization allows us to do is to consume a lot of information very quickly. So we showed this go, no go heat map that takes out the price panel from all of these asset classes, and we can just look and compare across the field what is trending and in what direction. So we've got U.S. equities, treasury bond prices, we've got the U.S. commodity index and the dollar on this chart. We could build maps that include anything that you would want to look at. Now, the other place that we wanted to bring you was to this concept of relative strength. So building off of Julius's presentation this morning, we're talking about the exact same concept that Martin Pring defined as just a very simple division, one security over another. And to show that, to illustrate that, we could just eyeball growth equities over value shares. If we're just eyeballing the charts, they look like they had about the same performance through COVID, right? Rallying up through 2019, crashing in early 2020, and then rallying out of that COVID collapse. Okay, well, that's not very helpful to an institutional investor that's trying to beat the benchmark. You need to allocate to that which is outperforming. So we use a simple relative strength line. That's here in the bottom panel, where we can see, indeed, at a much more objective level, that growth outperformed value through the entire collapse, meaning it went down less. The relative outperformance, of course, everything correlated to one, everything was moving in one direction, but we saw relative outperformance from growth equities. In fact, that outperformance began before the collapse and continued well through the first part of the rally. Now, it's great to be able to see a relative strength line. And we can identify these areas where growth outperformed value, value outperformed growth, growth again took the lead, and then value shares took the lead again. But what if we wanted to understand the trend of that relative strength line? Well, we could use a go-no-go chart, and that would be what it looks like. The growth versus value trade on a daily basis. And right now, growth is in a weak underperformance against the value shares, right? So we can see very clearly this trend pulling out between growth and value. And if you're beyond just style boxes, we could start digging into sector groups, right? So utilities versus technology. This is on a weekly basis, showing us that nobody needed to own utilities all through 2020 and 2021, right? This is the stay-at-home trade, long duration growth shares, a lot of the information technology, communications, and consumer discretionary companies grossly outperforming the rest of the stock market because the real economy was still shut down. But you can see this transition very sharply into 2022, where utilities have outperformed the technology sector soundly. Now, it's not very exciting to talk about at a cocktail party, but this comes back to John Henry's point that we really don't care what we are investing in. We're trying to be objective about what is working. So we can use tools like relative strength to allocate appropriately. Alex, do you want to talk us through this energy sector versus the S&P 500?
Yeah, this is just another example of using go-no-go trend on a relative strength ratio, because we know how important that is, but you want to be able to get a sense of the changing trend on that relative strength line. And you can see here that for much of this year, the energy trade was the trade to be in. The outperformance was shocking almost, and that was where the trend was. We saw then over the summer a correction, a no-go correction, as that relative strength reversed for a little while and then came back into a go trend. These charts are a few weeks old, and now you can see actually that the trend has continued again. So we're in now a relative go trend energy to the S&P. We're actually testing those highs from earlier in the summer. So, you know, an easy way to get a sense of the trend, looking at these relative strength lines, just by watching the go-no-go trend colors.
Absolutely. And we are huge fans of Julius de Kempenaer's work. Hopefully that came through clearly. But the idea of visualizing the relative performance of all sector groups, this is what drives a lot of the research that Alex and I write each week that goes out to our institutional subscribers. So if we start from the top down, looking at the asset class performance, we can look at those on an absolute basis or on a relative basis. And this go-no-go rel map is showing us all of the sectors, in this case, the S&P 500, in their relative performance to the benchmark index. And so you can see in the top three, we've got our growthier sectors: information technology, consumer discretionary, and communications. We drop down into energy, financials, and industrials and materials, and then into healthcare, staples, and utilities. So what this picture tells us is that there's a lot of defense on the field. We've got some strong go trends here in defensive sectors like healthcare, utilities, and staples. But the lone standout of consumer discretionary, as well as some constructive performance in financials coming back into play. So that gives us a sense of what's happening under the hood of the index level. We can look at the sector performance and from there dive into the individual equities within that sector. So congratulations. I know that was motor mouth on a Thursday afternoon for you all. But hopefully that just recaps a little bit of what we talked about in our earlier session. In the second half of the full presentation, what we really want to talk about is the complete go-no-go chart, because we know that trend is critical, but we also want to understand what's happening with momentum, with volume, and with volatility. So let's dive right into this, Alex, and let's talk about these tools. We've spent most of our time just on the top half of this chart, looking at the price panel. This next section, we're going to really dive into the go-no-go oscillator and everything that's happening in a single panel below price. And that's going to be our go-no-go oscillator, the squeeze, and the icons. So talk us through the momentum concept real quick, Alex.
Yeah, absolutely. We know that we want to do all of this, but we also know that we want to keep our chart free from clutter. So that's really the overarching idea behind all of this, is simplification of the chart. So we know we need to look at momentum. We know we need to look at volume. We know we need to look at volatility, but we can't get ourselves into that mess of having too much on our chart. And you can imagine here, these momentum concepts are all valuable. You've got things like shaken money flow, you've got the DMI, you've got RSI. You can name them. Name the indicator that you want to put on a chart, and then if you add those to the chart we saw before, where we were trying to identify a trend, we haven't even put volume on here yet. Then all of a sudden you've got a chart that is very, very hard to read. But we need the information. So what we've done then is taken the momentum tools, those foundational principles of momentum that we've studied and used with clients over the past 15 years, and we've blended them into one oscillator that gives us all of the information we need. So now we're looking at one price panel and one panel below, and that is all we need to get a complete sense of the technical picture. Now, what's of course needs to be stated is that you can use this oscillator in the same way that you would use any traditional oscillator, meaning we can find areas of overbought and oversold. When you get a high or a low on the oscillator, that's going to line up with a peak or a trough on the price chart. Most likely, you're going to see that mean reversion happening. You can also find areas of divergence. Divergence is an incredibly important concept in technical analysis, and we want to know when price is making a higher high, but it hasn't been confirmed by momentum. That suggests exhaustion in the trend, and we know how to interpret that. And we also want to incorporate volume in the oscillator so that, again, we don't overload the chart with more data. And volume is included by changing the color of the oscillator when volume is heavier than its average. So you can see on that no-go correction, volume really picked up, and there was a lot of market participation as we moved to that lower low in the middle of the chart. But
so if we just walk through, sort of the life cycle of a trade from left to right on this chart, we're in a go trend, right? We know that from these colors. Green and aqua and blue are going to be our go trend colors. The momentum oscillator is in positive territory. This ranges from -6 to +6. But we saw that volume became light on the oscillator. It was positive. We tested our zero line and found a positive move, but that was a divergent signal from the momentum oscillator, a lower high as price made this final high. We see that follow in a trend change. We go through the neutral levels and then into a no-go trend. At the same time, volume picks up. We've got heavy negative momentum, negative momentum into an extreme oversold on heavy volume. And the price trend continues. But we see a bullish divergence here on the momentum oscillator before that rally begins. The significance of that zero line is what we want to talk about next. Alex, why don't you dig into this a little bit?
Yeah, we know the value of using momentum, and we also have seen the research on using momentum oscillators when in trend. That's the really exciting part, because we know that momentum oscillators were designed primarily in the 70s during a sideways market. We were looking for peaks and troughs and how to use that in a mean reversion sense. But what about using it in a trend, the idea of momentum? And what you can do is you can see that momentum surges and then cools off, and it surges and cools off. And so people have done a lot of work in that space. You can think of RSI going overbought to above 70 and then coming back into its neutral territory. The hard thing with that kind of work is trying to find objective ranges for those momentum oscillators to find support. A lot of talk has been done about using RSI from 40 to 80 when in an uptrend. But the RSI is a very quick moving indicator. And what counts as a test of support? What if it comes down to 48.2 or 43, or what if it breaks down to 38 or 37? Does that count as breaking that support? Well, what we wanted to do when we designed the go-no-go oscillator was to calculate it in a way that causes the indicator to go to zero when all of the inputs, all of the blended inputs for the 5, 6, 7, 8 momentum inputs are in their neutral territory. So what happens then is you see the surges in momentum as the price goes through its trend. But on any correction or any weakness, we can look to the zero line to act as support in a go trend and resistance in a no-go trend. And those give us those opportunities to participate in a trend as it persists.
I don't know if anybody follows the TikTok traders, or you caught this phrase in 2020 and 2021, BTFD, right? When do we want to buy the dip? Well, that's the, as Julius was talking about, moving into a lagging quadrant and circling right back into leading. This is how we would visualize that using a go, no go chart, right? So we know that price does not move in a straight line. And so we're going to have periods of corrective behavior, consolidation within an uptrend. And looking to the momentum for that signal, seeing support at zero is really how Ralph Acampora described momentum to me in the first month at the CMT Association. He said, Tyler, think about momentum as a baseball. Now, Ralph's from the Bronx. Everything's baseball with these guys. He said, you've got a baseball in your hand, and when you throw it up in the air, it's moving fastest the minute it leaves your hand. And then it's going to reach the apex. That's how high you throw it. That peak point, it's going to decelerate. And it's going to come back down. As long as you catch it in your glove, you can throw it right back up again. And the game goes on. It's a game of catch. So when we think about the zero line, that's momentum coming back into your glove. Game's not over because we're still at positive and neutral levels. And that zero line provides an objective level of support in an uptrend. Polarity principle tells us it also provides resistance in a downtrend. And unfortunately for everybody, we're going to look at a lot of no-go charts today when we look at these live examples. Yep. It's been a tough market. Yep. Alex, let's talk about using data visualization to capture these moments of the interplay between go-no-go oscillator and the go-no-go trend indicator.
Yeah. And I love the mention you just made there back to Julius's Rrg, that rotation purely on the right side of the chart is really the bounce off the oscillator on a go-no-go chart. So on a single security basis, looking at the complete suite of tools, that's where you have those moments to participate in a really, really strong trend that wouldn't have deteriorated into the underperforming quadrants on an Rrg chart. But so yes, here are the icons. We want to make things as visually simple as possible. We're both incredible believers in data visualization and how that can help decision making. And so all of these important things that are happening with the interplay between the oscillator and the trend, we want to try to give you visual cues on the price panel to keep your eyes focused on price. And the first one are these circles. These are trend continuation icons. And those are exactly those moments that we just described where you are able to participate in a strong trend. And you can see that when the oscillator finds support at the zero line, you're going to get continuation icons on the chart. Now, if it was a no-go trend and it was resistance you were hitting at zero, these would be red no-go continuation icons. The second type of icon that you see here are these arrows or triangles. And those are counter trend corrections because we all agree, right, that there is a lot of value in looking at momentum in its traditional sense. So if momentum has become overbought in an uptrend, then we want to know when that cools off, because that gives us that idea of mean reversion in the short term that price may struggle to go higher. Remember, momentum is price velocity, and if it's swung really quickly in one direction, we may well see a pause or a consolidation or some kind of counter trend correction. So we're going to put those on the chart as well. And the flip of these would be that in a no-go, they would be green counter trend correction arrows. But all of that then is going to be on the price panel to keep us looking at price.
And so when we were talking about the expectancy formula at the very beginning of the presentation, and what we've learned from great trend following investors like John Henry and Mark Abraham and Jerry Parker and David Lundgren and many others, is that in order to get those outsized gains that help cover up any of those small losses that when we get whipsawed out of positions, trend followers are looking for these opportunities to pyramid into a position, to scale up their sizing. As Frank Teixeira said, you have to play with fear and arrogance. So when a trend is working, you have to really press your bets and move to the upside. So finding areas to objectively buy into a dip, right? Get in at a lower price and continue that trend higher. When we see a trending market and we've got the confirmation of a resurgence of momentum in direction of that trend, we know that we can really press our bets. So that's how these tools have been designed, is to help trend following. If that's your philosophy, you could do this on any time frame. However, if you're intraday, no problem. The charts work exactly the same. So Alex, let's dive into the last piece of data visualization. We've talked about trend, momentum. We know how volume is incorporated. We've got these icons. Let's talk about the go, no go squeeze.
Yeah, as you said, it was the last piece of the puzzle for me. Being in my seat at Bloomberg as a technical analysis specialist, I needed to be able to talk to anybody in the industry about any asset and give them a complete overview of technical analysis. And so volatility had to be a part of that. But I wanted, again, to do it in a chart that made it very simple for me to pull anything up and get an idea without having to put, again, the complex number of panels and indicators on the chart. So what we're looking for with the go, no go squeeze is our volatility squeezes. So if you're familiar with things like Bollinger Band squeezes, Keltner Band squeezes, we're looking for areas of reduced volatility where price has compressed its movements, or not too much is happening. If you think about squeezing a tube of toothpaste until the cap pops off, that's the idea here, that after a period of a reduced volatility, after a squeeze, a go, no go squeeze, you may see a break or a pop in a certain direction. And we know from our research that that could be significant. So what you've got is all of the inputs to that momentum oscillator, the go, no go oscillator, are in and remaining in neutral territory for an extended period of time. And that allows the grid, the orange grid there, build to its max. And we call it, we're riding the zero line here. And we, all else being equal, what would we expect? If we're in a go trend, we would expect that zero line to hold as support. So when it breaks out of that squeeze to the upside, that could mean a new leg higher in price and continuation of sort of a low risk opportunity to get back into that trend. Now, of course, in a situation where that squeeze is broken to the downside, if we're in a go trend, then that would also be important information, because we would be saying, even though the trend is a go, we're getting some oversold conditions. We're getting some excessive selling, which shouldn't, in theory, happen in a go trend. So that squeeze, the breakout of the squeeze, can give us really, really important information. And just real quick, I know you're going to jump in there, but just real quick, we had a question come in the chat about where does the confidence come from in these charts, and it is a combination, as you're suggesting, between the rationale of what we're doing here and some back testing that we've done. But like Julius mentioned, this is more of a chart type. We want to give users a complete understanding of technical analysis when they look at any asset over any time frame. So in this purest form of using the go, no go charts to understand the markets, it's not a black box system or any kind of recommendation. We know that every individual is different. You might be looking at this on a 5-minute chart, day trading E-minis. We might be working with an institutional portfolio manager who's using weekly data and rebalancing quarterly, like Rrg showed in his tests. And so we are, we've done some of those back tests, but as Julius mentioned, it will so depend on what you're trying to get out of your investing. And so we always then return to the rationale behind this, that it is blending some of the most foundational concepts of technical analysis into a simple visual that allows you to get a complete overview of those technicals on any asset.
Yep. Not a black box. We're not here to tell you how to trade or what time frame or what your risk parameters are, but this should provide an objective and complete technical view to fit anybody's trading style. And we also know that there are lots of folks out there that might look to Fibonacci extensions or retracements, might look at Elliott wave counts, might look at other things that they would like to have on their chart.
Trend lines.
Being able to put on, a simple trend line, areas of support and resistance, those pop off the chart because it's not cluttered with lots of other studies. You still capture all of that trend, momentum, volume, and volatility information, but without cluttering the chart. And real quick, what I wanted. Oh, hey, Joel.
Sorry about that. But I have one other interesting question that I'll flash for you on screen. This comes from Hussein Alidost, who's live on YouTube right now.
Great. Candles change color and use patterns and price action to decide. So, Hussein, and for everybody who's on the line, when you're looking at a longer term chart, so a weekly bar or a monthly bar, even during the day, if we have a really high volatility session, the colors could change during the course of that time period. So on a weekly bar, between Monday and Friday's trading sessions, we're going to see, if it's a really highly volatile week, we could see something move from a go trend to a no-go. But they are never restated or altered after the fact. Once that period ends, the bar is locked in and it's never adjusted. So when you're looking at trading live charts, I think it really comes down to what your objective is. If you are a longer term trend follower, as Alex said, you might be rebalancing or doing some tactical asset allocation across sector groups or across asset classes. If you are a short term intraday trader trading single securities, you could use this complete go no go chart to follow that trade. And so that was a great question, because it leads right into what I was going to say next, which is you never know what's going to happen next on the chart. So if we just back up this to this conversation about the go no go squeeze, right? We've been in a go trend. We saw some peaks, some overbought signals. We saw a momentum resurgence. We had heavy volume on this move higher, but then we've sort of stalled out. So how do you know if this if this trend is going to continue, or if this is the top of the trade, right? A go no go squeeze is helping us visualize that tug of war between buyers and sellers. If you've ever watched Squid Game, you know that tug of wars can end in a very violent move for the opposing team. And what's happening right here, when we're just trailing the zero line, we don't have control from either bulls or bears on this chart. When there is a decisive point of control, then all investors move to that side of the trade, right? That's the human behavior. When it is clearly moving positive, people close out their shorts, they pile in to the uptrend. So if we move the chart to the right, the break of the go no go squeeze, the return to positive momentum, happens even before this large price move, right? And then we see volume pick up. Now we're on heavy volume, price is surging higher, and we have that go no go trend continuation icon. So for Hussein and for anybody who's thinking about how to trade these in real time, we're using that confluence of technical information to give us a complete picture so that we can trade objectively, not based on any narrative or forecasting or storytelling.
Yeah, and I might just add too, Hussein, that we do a lot of work with clients that are trading very, very fast charts, live trading, day trading, intraday trading, and we really do suggest multi-time frame analysis for technical analysis in general, right? So we need to make sure that we have a market bias, and we need to know in which direction we're trading. So perhaps if you incorporate knowing what the trend is on an hourly chart. If you're trading a 5-minute chart, then you're going to be looking for, let's say, if the trend is a go on the hourly and a go on the daily, then you're looking for goes on that 5-minute chart to make sure you're trading in the direction of the trend. And also perhaps these trend continuation icons could help too, because those are telling us that they're relatively low risk entry opportunities because momentum is back now in the direction of the trend. So of course, live trading, super tough. But there's ways to incorporate some of the other principles and concepts of technicals to help there too.
And Joel, I see some of the other questions piling in. There's lots of educational material, not paid training, but we host a weekly show on Stock Charts TV. We produce research every day of the week and 2 long form pieces every Monday and Saturday, just to help guide our institutional subscribers through the process. A lot of that is free on our site, gonogocharts.com. So you can go check out all those educational resources there. Let's shift gears. We've got a lot of live charts to run through. And hopefully that's a good takeaway for everybody. To see how we use these charts in action, we really want to simplify the trade decision making, right? We only have to answer 3 questions. Where's the trend? What's happening with the oscillator? What level is it at? Is there anything important happening at the zero line? So we can do these together. Let's take a look at the India's Nifty 50. Alex, what are you seeing on this chart? And you guys can all shout it out at home. What's our trend color?
Yeah, so we pulled these, I think, on Tuesday, but the Nifty was in amber go fish bars, right? So some uncertainty. We are at 0 on the oscillator. And of course, remember, there are 3 things we just need to know. The third one is there anything interesting happening at the 0 line? And of course, in this chart, we were testing the 0 line from above to see if we would find support there. We can also throw on that downward sloping trend line to get a sense of the resistance from our traditional technical analysis as well. And you can see that we failed and struggled at that level, and now we are below it, but looking to find support at the 0 line.
Absolutely. And that's the weekly view. If we jump into the Nifty 50 on a daily chart, we can see a little tighter price action. Let's walk through this. We've got pink bars. We're on a weak no-go. Where's that oscillator at? Right back at 0. But what's important is that it's retesting 0 from below. right? We've got the squeeze beginning to build. All else being equal, we're in a no-go trend. We've been in negative momentum. We would expect this to roll over. So it's a clear signal to us. If we break positive on the go-no-go oscillator, that's a real threat to this downward sloping no-go trend.
And over the last couple of days, that no-go has continued, and we've dipped back into negative territory and are testing the zero again. So at the moment, that zero line is providing the resistance that we would most likely expect in a no-go.
Absolutely. Now, we've been talking about relative strength and beating the benchmark. And for all of my American compadres, we should be investing in the Nifty, not in the spiders or the S&P 500. Look at this relative outperformance of the Nifty 50 against the S&P 500. And this continual support at zero as this trend continued higher. Obviously, when we see a stronger break away from the zero line, continuing higher on the momentum readings, we've got strong go trends. We've got lots of trend continuation icons. Our oscillator is currently at a +1, and we have seen that repeated support telling us that the trend on a relative basis for the Nifty 50 against the S&P 500 has been very positive. So that's the concept that we're talking about, is asset allocation, moving to what's working. As they say, you got to fish where the fish are. All right, let's go through a few more.
Yep.
Infosys. Alex, walk us through this.
Yep. So Infosys, we know this is a weekly chart. Where are we in the trend? We know we are in a strong no-go trend. We are approaching, or just actually come back to the zero line on heavy volume, it looks like here. And so what we're going to be looking at is whether or not we find resistance at that zero line. So heavy volume as well. So no-go certainly in place on Infosys on a weekly basis.
Let's dive into HDFC Bank. Go ahead, guys. Shout it out. We've got weak no-go trends on a daily basis. We've got an oscillator at zero, building the grid of the go-no-go squeeze. So we've got some tension between buyers and sellers. We'll look to see a resolution on the go-no-go oscillator to see a leading indicator for trend and direction.
Yeah.
All right. Reliance Industries. We're on a daily basis. We've got a weak no-go. We're at zero. We're building the squeeze, but it's retesting zero from below. Looks like that heavy volume is recently drying up, and we're seeing a little bit of uncertainty in this no-go trend.
Yeah.
All else being equal,
over the last couple of days, these charts have they've pretty much not resolved, but they've continued in their no-goes, and the oscillators are still finding resistance at the zero line.
Brilliant. Let's talk about Tata. On a weekly basis, very similar chart. We're in a strong no-go. We've got an oscillator at -1, and we're remaining in negative territory. A series of lower highs and lower lows for Tata on this weekly basis. We'll look to see if we can find something more constructive for you all at our next next presentations. This is the same company on a daily chart. Again, as Alex was saying, the importance of multiple time frames, right? So if we know the underlying bias for Tata is to the downside, right, on a longer time frame, then when we dive down to a daily, perhaps you're trading short positions, right? Your underlying bias is to the downside. Maybe you're taking a short position at these trend continuation icons to the downside, leaning into them when we see these resurgence of momentum into negative territory, and closing out your positions when we get to an amber neutral bar, right? We rode the zero line. We saw a trend shift to a neutrality or go fish. Maybe you close out your short position before this momentum surges higher and we actually enter a go trend for a period. That's how we would think about trading over multiple time frames. If you're even shorter, you could dive down to a 30 minute to get very sensible entries in this downward sloping trend. All right. We've got a weak no-go on the daily basis. Our oscillator is at +1. We're showing some constructive signs. We've had some strong days. At least this was on Tuesday. Alex is probably looking at live charts right now, telling us that, where did we resolve so far this week?
We're still on a weak no-go, but the oscillator was able to stay in positive territory. So a good sign there if you're looking for something more constructive on this Tata chart.
Brilliant. We've got the Tata versus the Nifty, right? So again, coming back to that concept of relative strength, if we're looking at an individual security against a benchmark, we're seeing Tata is underperforming the Nifty 50. We're in a weak no-go. We've built that squeeze. The oscillator has broken out to a +1 on a relative basis. So we're seeing something constructive for Tata against the index. But all these ideas are what we try to capture in our research every week. As I mentioned, we take a top-down approach. That's how we teach it at the CMT Association. That's how Alex and I have learned it. Starting with the asset classes, get a sense of the nature of the markets, big picture, macro drivers, then dive into the sectors, look at some relative strength work, and finally pull out some individual securities that are going to have the right kind of conditions for us as trend-following investors. That work, right, goes all the way. We've been doing this for a few years now, but in January of 2022, we saw this sharp change of character, right? Energy was the outperforming sector of the S&P 500 in 2021. We saw leadership coming from the small energy market, but we also saw a rotation back to cyclical sectors broadly and the end of that real growth equities trend at the beginning of the year. And why is that? Well, we have to take a look at interest rates long term. Go right back here to right back here to where Alex was born, right here where Joel was born, right here where Tyler was born. Point being, for the last 40 years, we've been in a bond bull market, right? Yields move inversely to prices. And so this downward sloping trend line on yields, TNX is the 10-year treasury yield, we broke above. And this is a quarterly chart, folks. We're talking about very long, slow-moving, geological time for the stock market. We broke above that 40-year downward sloping trend line and then confirmed another quarterly close above it. And if you can train your eye to get in nice and close, we're on go bars, right? This was all just a mean reversion, snap back to the long-term trend line. We broke above and we've continued to close higher. So the trend for treasury rates or yields is to the upside. And we want to be very careful in a rising rate environment where the Fed is removing liquidity, trying to grasp those long duration tech names, those mega cap firms that were the darlings of the COVID collapse. They're just not working the same way. Investors don't have the patience for those growth equities at higher and higher costs of capital. So that's the kind of macro work that we do. This is the same TNX chart, just on a daily basis. We did see a little relief rally over the summer in U.S. equities, driven largely by a cooling period in those yields. They've taken off higher. We broke back above prior highs, and we're off to the races. So trend's a strong go. Oscillator is at 6. We're strongly overbought. But as Ralph has told us, right, all these trend consolidation or correction arrows tell us that we are continually bumping up against the ceiling. We've got overbought readings on these yields, which is extremely bullish. And there are a lot of trend followers who actually look for that as a sign of real strength to buy into. Yeah. The other major chart, Alex, I don't know if you want to talk about the US dollar reclaiming some of those 2002 highs.
I also don't appreciate the humble brag about you being slightly younger than me there on that quarterly rates chart. I think you were showing the cursor a little bit too far to the right for you. I don't know about that. Anyway,
I'm actually 25. I've just lived a really hard life, which is why my body looks like this.
But yeah, the dollar has been the trend, right? The dollar has been the trade this year. We've talked about it at length on our show and in our research. Just goes from strength to strength, and we've talked about how we've had other colleagues in the industry who've been looking for it to roll over, and it really hasn't yet. And we continue to see go trend continuation icons there on the right side of that chart. And we've seen since this chart more support and the dollar managing to stay in its go trend. So we can wrap on this chart. This chart, when we took it, was a strong go. Oscillator is overbought at 6. And we've been finding support at 0. But I know that Joel was trying to get us to wrap just about quarter after the hour. So I don't know, Joel, if you're there, we can wrap here.
Absolutely.
I'm here indeed. But with asking you to wrap is so tough because it's so much fun to hear you guys in action every time. So what we could do is move the conversation over to Discord and then kind of have it a little more free form there. But guys, it's so much so educative every time you guys are on stage and talking markets, talking go no go chart specifically. Just so much fun. So let's have a little chat back in Discord and then we can call it a day.
Absolutely. And for everybody who's watching, if you need to get a hold of us, if you're using these and you have some questions about how best to implement in your own trading system, you can find us at gonogocharts.com, or you can send us an email, info@gonogocharts.com. So thanks so much for having us, Joel, and we'll see you all November 5th at the Asia Pacific Summit in Mumbai, India. Cheers.
That's going to be fun.
That's gonna
Thank
be
you so
fun.
much.
All right, buddy. Talk soon.